Welcome to Facts, Figures, and Fallacies from the Frontline podcast with Mitzi E. Sullivan, CPA.
Welcome to today's episode and podcast of Now It's Time for a Roth IRA Conversion. And just make sure to check out the Facebook, LinkedIn, and Twitter links at the bottom to follow us. We also have a monthly newsletter where we release like the newest tax laws or anything that could possibly be related to your business. So be sure to sign up for that too. And with that, I'm going to hand it off to Nick to discuss the Roth IRA conversion.
Thanks, Jessica. So today, the first thing I want to start off talking about are the differences between a Roth and a traditional IRA or 401k. And really, this applies to any retirement savings account, but I'll be using the word IRA in a lot of these examples. So, for example, a traditional IRA, many might be familiar with, but that would be when you contribute your money into a retirement savings account, an individual retirement savings account, and you actually get a tax deduction for that. And so the reason for that is because this is your income that's already been taxed, and now you're contributing it into this retirement account, and you're going to receive a tax deduction on your in the amount of your marginal tax rate. So, for example, if you contribute $1,000 into an IRA and your marginal tax rate is 24%, then you're going to save $240 in tax by contributing that $1,000 into the account. The other potential account would be a Roth. And the way that the Roth works is you contribute, say, $1,000 into the Roth account. However, you don't receive that tax savings. You do not receive the deduction. But the benefit to the Roth is that $1,000 that you put into the Roth grows, and it grows tax-free. And so then when you take it out upon retirement, you're not taxed on that distribution. Whereas in the traditional, since you receive that deduction when you contributed the money, well, upon retirement, when you distribute the funds of your traditional account, you're actually going to have to pay tax on that. And so there are benefits to each option. And so that's what we're going to talk about today. And then we're also going to talk about how people who may be above the AGI limit for a Roth can still get their money into a Roth account. And so the first thing we'll start on is, why would you want the Roth, or why would you want the traditional? And there's reasons for each, and they're really dependent on your personal situation. So the traditional IRA, a lot of people think, maybe right now I'm making the most money I'm ever going to make. And so if I get to take advantage of that deduction now, that marginal tax rate that I'm in is a lot higher than it's going to be in when I retire. And so the idea would be that I'm putting my money in now, I'm getting this tax deduction now in a higher tax bracket, and then when I retire, I'm not going to have very much of an income, and so I'll be in a much lower tax bracket. And so, they're thinking that that's actually, the best idea for them. But what we see with a lot of our clients, and what we're hoping and what our goal is, would be that upon retirement, you're not in a lower tax bracket. And in fact, you've, managed your wealth in a way that in the future, you're actually in a higher tax bracket. And so the idea would be contribute to the Roth, don't take a tax deduction now, so that when that grows over your life and you take that money out upon retirement and you're in a really high tax bracket, you actually don't even have to worry about paying the tax. And so that's our goal for our clients. And, you might be listening to this and you might be saying, well, that all sounds great, but I make too much money to contribute to a Roth account. And the way that it works now currently is you cannot contribute to a Roth if your adjusted gross income as a single person is $144,000 or higher. And if you're married filing joint and your combined adjusted gross income with your spouse is above $214,000, you also would not qualify for the Roth. And so that's what's holding back many people from having a Roth IRA and contributing, for example. But there's actually something that the government has enacted that allows people to get their money into a Roth regardless of the income
So
limit.
it's not cheating.
No, it's not cheating.
I love how you always, your firm or your business always says, there's a way we can do that.
Yes.
And
So, it's perfectly legal. The government is fully aware of it. And I will say it's very possible that in the near future, they do away with this option because, people are always trying to find the best and most strategic ways to, have tax savings. And so the IRS and the government, they're aware of these things, but currently this is called a backdoor Roth conversion, and it's perfectly legal.
It does not sound legal, but it is.
It is, yes, it is. And that's where the term backdoor comes from, because it is something, it's definitely a strategy that wouldn't, I guess you could say it's not, maybe not the traditional way of doing something. So one other thing that I'll say on that is I wanted to mention that everyone's situation is different. And so we don't want to give any advice. We don't want you to take this and run with it before you are consulting either your CPA, your investment account advisor, or even us, just so that we can see your personal situation.
Yes, and so what we've seen with our clients, almost with most clients, and of course everyone's situation is different, but we almost always advise our clients, maximize your Roth contribution. If you've already paid the tax, go ahead and get that $6,000, $7,000 per year per person in that Roth and let it grow so that when you get ready to retire, your investment has grown. That could be in a self-directed account. Maybe you're investing in real estate. Maybe you're in the stock market. But let that investment grow tax-free and come out tax-free. That's just a great strategy.
Yes, definitely. And in that previous example, that would be a situation where you're above the AGI. You aren't seeing those tax savings, so you're paying the tax up front. Mm-hmm. Now, a lot of people are below that level and they've set up a traditional account already. And so, what do you do if you have, a lot of money in a traditional account that you've already taken, deductions on? And so if you're interested in getting that account into a Roth, I think now is a great time to do that because the market is so low. Because if you've put your money into a traditional account and taken those deductions, when you convert it to a Roth IRA, you will have to pay the tax on that conversion amount. But if the market's low, your account balance is lower right now, then now would be the best time to make that conversion so that the tax you're paying is on a lesser conversion amount.
Right, and also the tax rate. This is an all-time, probably the lowest rates we'll see in our lifetime. So that also makes it a great time to convert.
So let's say that you're falling in that situation where your AGI is too high and you cannot contribute to the Roth. Well, you can contribute to a traditional. So because your income is so high, you actually wouldn't receive the deduction that I mentioned earlier by contributing to the traditional. So the benefit of the traditional IRA is you're getting that tax savings when you contribute, but if your income's too high, you actually aren't going to see that deduction because that phases out. And so let's say your income is too high. What you can do is you can contribute to the traditional account, and then on the very same day, you can convert that to a Roth account. And so the way that works is you contribute to the traditional, you don't get to see the tax savings, so you're already paying tax on that contribution. And then on the same day, you can convert the account into a Roth account. And then that money that you've contributed is growing tax-free over your lifetime. And so now would really be a great time to do that because the market is lower. Obviously, The market's pretty low right now in the economy. And so when you do a conversion, you have to pay tax on the conversion amount. So if I put $1,000 into a traditional IRA, I would normally see a tax deduction. Well, if I'm above the income limit, I don't see that deduction, right? So I put $1,000 in. On the same day, I convert it to a Roth account, and then I'm going to receive a 1099 form about the money that I converted, and I'm going to have to pay tax on that. However, if right now the market is kind of low, so the balance of many people's retirement accounts are lower, and so that would be a reason why now would make a lot of sense to do that conversion. Also, in 2018, the Tax Cuts and Jobs Act was passed, which lowered the tax rates, and that's set to expire in 2026. And so once we get to 2026, it's very likely that the tax rates are going to increase again. And just for sake of example, the highest tax rate in 2017 was about 39.6%. And after the 2018 Tax Cuts and Jobs Act, that decreased to 37%. So it's down almost 3%. And when we get to 2026 and that expires, it will likely go back up to 40 or potentially even higher, that highest marginal tax bracket.
So really, we need to get this done in a couple years if we're going to make conversions.
Yes. Now is just now is a great time if you're thinking about it because the market is low, whereas next year it may be lower, so it could be beneficial to wait until next year. But if this is something that's sounds beneficial to you, I wouldn't put it off until 2027, for example, because by then, tax rates will likely be a lot higher. The market may be back and booming again. So this is a really good strategy in a time when the market's low, and especially right now that the tax rates are lower.
Right. So a lot of times what we see with our clients is they have been contributing to the traditional accounts, pre-tax dollars, getting that tax savings because they're working, they're making the most amount of money that they think they will ever be making. And their 401k has grown to maybe it's $1 million, maybe it's $2 million. Well, when they retire, and those are traditional accounts, they have to take those required minimum distributions. And a lot of times what that does is make their Social Security taxable. 85% of that Social Security becomes taxable income because now you're adding that retirement income, and they end up in a higher bracket. Plus, you've got the prospect of higher tax rates, after 2026. And so what we've seen has been very beneficial. Again, everybody's tax situation is different. If you're sitting on a $500,000, $1 million 401k IRA retirement plan account, this is a great time to consider, and I'm not saying go out and do it, but a great time to consider converting at least a portion of that retirement account over to a Roth so that when you retire, that money will come out tax-free. It doesn't increase your modified adjusted gross income, so your Social Security then would also not be taxable. So you may be, you may have $200,000 or $300,000 worth of income, in your retirement years, and you're still in a zero tax bracket, which is beautiful.
And that's another interesting point. You don't have to convert the full amount of the account at once. And so, I mentioned earlier, when you convert from a traditional to a Roth, you do have to pay tax on that conversion amount. However, you can maybe split that up over a couple of years. So, for example, if your account has $1 million in it, instead of converting $1 million and having to pay tax in the highest tax bracket, you could split that up over a few years and convert maybe only $200,000 at a time. And keep yourself in a lower tax bracket.
And at the same time, probably target that 2026. So if this is something that benefits you and something you're considering, you've got about 5 years to get whatever you want converted, and at the lowest rates probably that we will see in our lifetime.
Those would be the big differences between the Roth versus the traditional, and then also just why now is the time, to do that. And a lot of people may be looking at their account Like me, I have an IRA account, a traditional IRA account, for example, and I'm seeing that, over the past year, it hasn't been doing so well. And as that is discouraging, there's also this incentive. Maybe now is a great time for me to convert mine. And that's something that I'm considering doing as well in my situation. So yes, I think for a lot of people, this could be very beneficial right now.
Mm-hmm. And to be clear, you're not a financial or investment advisor.
We're not.
You work with them. You have people that you can.
Exactly. And so we have, we're happy to, for our clients and for anyone who may be considering this, we can definitely help with tax advice and help look at their situation. But we are not an investment account advisor. So, you would have to go to your investment account advisor to actually, perform that conversion.
Yeah. But if they don't have one, you have multiple people that you work with that you could.
That's right.
Advise.
We do. We definitely have some people that we work with who we would recommend. And yeah, if you have an account set up maybe through, Fidelity or one of these companies that manages these retirement accounts, you can contact the your account holder, your account investment advisor, and they can help with the conversion process.
Okay. And that's probably a whole new podcast, but crypto, taxes on crypto investment, and can you convert those over?
You can actually have a crypto IRA, traditional or a Roth.
Okay.
And yes, that is a whole new podcast.
That is a whole new podcast because I have so many questions on that.
All right. Well, I think that about wraps up this episode. If you have any questions, please do drop a comment below. If you have any topics that you'd like us to talk about, also please comment below. Send us a message on Facebook, Twitter, however you'd like to communicate with us. And thanks so much for tuning in.
Thank you for tuning in to today's episode. Make sure you follow us on Facebook, LinkedIn, and Twitter at the links below. Also, sign up for our weekly newsletter to make sure that you stay up to date with the changing tax laws and regulations. Leave a comment if you have any questions about today's topic. We'll see you next time.